Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and sitting across from me, as always, is Lana Chen. Today we are cracking open one of the oldest and most diversified names in healthcare, Abbott Laboratories, ticker ABT.
Abbott is a fascinating one, Hudson. This is a company founded in 1888, over 138 years ago, by a Chicago physician named Dr. Wallace Calvin Abbott, who started making granulated medicines in the back of his pharmacy.
From a pharmacy in Ravenswood, Chicago, to a $174 billion global healthcare conglomerate operating in over 160 countries. And the timing on this episode is perfect.
It really is. Abbott just closed a $21 billion acquisition of Exact Sciences, the Cologuard cancer screening company, in March 2026. Meanwhile, the stock is sitting near 52-week lows. Lots to unpack here.
So let's start with what Abbott actually does, because this is one of the most diversified companies in the entire S&P 500 healthcare sector. They operate across 4 segments.
The biggest is medical devices at 48% of revenue, $21.4 billion. That's where you find the Freestyle Libre continuous glucose monitors, electrophysiology products, structural heart devices, and neuromodulation technology.
Then you've got diagnostics at 20%, about $8.9 billion, core lab testing, point of care, molecular, and rapid diagnostics. This was the COVID testing juggernaut segment.
Nutritional products at 19%, $8.5 billion. Similac, Ensure, Pedialyte, Zone Perfect, names you see at every grocery store in America.
And established pharmaceuticals at 12%, $5.5 billion in branded generics, sold primarily in emerging markets like India, China, and Latin America.
That 4-pillar structure is intentional. It's the legacy of Abbott's decision to spin off AbbVie back in 2013 and the St. Jude Medical acquisition in 2017. The result is a company that generates revenue from babies to seniors, from hospitals to home testing kits.
Running the show is CEO Robert Ford, who took the reins on March 31st, 2020, literally days after COVID was declared a pandemic. Talk about baptism by fire.
Ford is a 30-year Abbott veteran. Joined in 1996 in the diabetes care business. Rose through medical device leadership, headed the $25 billion St. Jude Medical integration. Named president and COO in 2018. Holds a bachelor's from Boston College and an MBA from UC Berkeley's Haas School of Business.
And his first act as CEO was arguably the most impressive corporate pandemic response in all of healthcare. Abbott shipped over 400 million COVID tests in 2020 alone, with the Binax Now rapid antigen test.
Since then, he's pivoted hard toward growth through innovation. Freestyle Libre, the Volt PFA system, and now the Exact Sciences deal. He's been chairman of the board since December 2021.
All right, Lana, take us through the numbers. What does the financial picture look like?
Full year 2025 revenue came in at $44.3 billion, up 5.7% year over year. The quarterly trajectory was encouraging. $10.36 billion in Q1, $11.14 billion in Q2, $11.37 billion in Q3, and $11.46 billion in Q4. Steady upward progression throughout the year.
Up and to the right every single quarter. How about the bottom line?
Adjusted earnings per share came in at $5.15 for the full year, reflecting 10% growth. GAAP EPS was $3.72. The spread between adjusted and GAAP tells you there are meaningful one-time items, including acquisition-related costs.
What about margins?
Gross margin sits at 56.4%, one of the strongest in diversified healthcare. Operating margin is 18.6%, and net margin is 14.7%. For context, the gross margin at 56.4% actually exceeds Thermo Fisher's 41% and is only modestly below J&J's 67.9%.
Now let's talk valuation, because the stock has sold off significantly from its highs.
The trailing PE is 28.2 times earnings. But here's what's interesting. The forward PE drops to just 18.5 times. That gap tells you the market expects meaningful earnings growth ahead. Price to book is 4.1 times, EV/EBITDA is 18.7 times, and the PEG ratio sits at 1.8.
So on a forward basis, 18.5 times. That's actually getting cheap for Abbott, isn't it?
Very much so. The 5-year average forward PE for Abbott is closer to 24 to 25 times, so the stock has derated about 25% on a forward earnings basis. That's the market pricing in near-term uncertainty around the Exact Sciences integration and the diagnostics headwind.
What does the cash flow picture look like?
Free cash flow came in at approximately $7 billion, giving you an FCF yield of about 4%. That's solid and well above the S&P 500 average of roughly 3%. This is a company that converts its earnings into real cash very effectively.
And the balance sheet, especially important with a $21 billion acquisition to digest.
Heading into 2026, total debt stood at $16.8 billion, net debt at $8.5 billion, and the debt-to-equity ratio was just 0.27. Current ratio is a healthy 1.58. Debt to EBITDA was 1.52 times. The Exact Sciences deal will increase leverage, but Abbott entered this acquisition from a position of real strength.
Tell me about the dividend. This is where it gets really impressive.
Abbott is a dividend king, 52 consecutive years of dividend increases. The current annual dividend is $2.52 per share, yielding 2.48%. They raised it 6.8% in January 2026. The payout ratio is 63% on a GAAP basis, but only about 36% on a free cash flow basis. That leaves plenty of room for continued increases. 5-year dividend CAR is 7.2%.
52 years of consecutive increases. That includes the 2008 financial crisis, the AbbVie spinoff, the pandemic, inflation. They've raised through all of it.
Overall, Abbott's financial health is solid. A well-diversified revenue base with strong cash generation, manageable leverage, and a 52-year track record of rewarding shareholders through thick and thin.
Let's see what Wall Street thinks. The analyst consensus on Abbott is a buy, with 17 analysts covering the stock. The median 12-month price target is $136, which implies roughly 34% upside from the current price near $102.
The range runs from about $113 on the low end to $158 on the high end. Notable calls include Barclays at $144 with an overweight rating. They just raised their target on April 8th. Morgan Stanley at $140, also overweight, and Wells Fargo at $135, overweight.
So the street is selectively getting more constructive, even as the stock sits near its lows. That's an interesting divergence.
On the insider front, we have a notable signal. Director Daniel Starks made an open market purchase of 10,000 shares worth about $1.09 million. When a board member writes $1 million personal check for shares, that catches my attention.
Any selling to worry about?
Routine dispositions from a few executives, EVP Louis Marone, SVP Eric Schroff, and SVP Mary Moreland, each sold relatively small amounts, largely for tax withholding on vesting shares. Net-net, the director purchase is the standout signal.
Last quarter's earnings, Q4 2025. Give us the scorecard.
Adjusted EPS came in right at the estimate of $1.50. Revenue of $11.46 billion missed the $11.8 billion estimate. So an inline quarter on earnings, but a slight miss on the top line. The market punished the stock, but the guidance was actually constructive.
What did they guide for 2026?
Organic sales growth of 6.5 to 7.5% and adjusted EPS of $5.5 to $5.80, reflecting about 10% growth at midpoint. And the next catalyst is Q1 2026 earnings on April 16th, just 3 days away.
Let's check the options market. The put-call ratio sits at 0.89, which is mildly bullish, more call bets than puts.
Implied volatility is in the 35th percentile, which is surprisingly low for a stock hovering near its 52-week low. Call open interest is clustering around the $110 to $120 range, suggesting options traders are positioning for a recovery.
Elevated activity heading into that April 16th earnings report makes sense. Traders appear to be betting on a beat and raise scenario.
Or at least a confirmation that the underlying business is inflecting. That's the setup.
All right, time for the bull and bear cases. Let me lay out the bull case. Catalyst number 1, Freestyle Libre. This franchise is a monster, over $7.5 billion in revenue in 2025, growing 17% year over year, with more than 7 million users across 60-plus countries.
And the kicker is the CMS reimbursement expansion for non-insulin type 2 diabetics. If that comes through, it roughly doubles the addressable market. That's not a speculative catalyst. It's a regulatory decision that's actively being evaluated.
Catalyst 2 is the Volt PFA system for atrial fibrillation ablation. It launched in December 2025 with clinical data showing 84.2% freedom from recurrence at 12 months. The electrophysiology market is a $10 billion addressable opportunity.
Catalyst 3, the Exact Sciences acquisition. Cologuard is the leading cancer screening platform projected to bring in about $3 billion of revenue in 2026. This transforms Abbott's diagnostics segment from a post-pandemic headwind into a growth engine.
Catalyst 4, the guidance itself. When you strip out the COVID testing noise that's been dragging on the numbers for 2 years, the underlying base business is accelerating. Mid to high single-digit organic growth plus 10% EPS growth at a forward multiple under 19 times.
And Catalyst 5 is the dividend. 52 consecutive years of increases, a recent 6.8% raise, robust free cash flow coverage. Abbott isn't just a growth story, it's a compounding machine that pays you to wait.
Now for the bear case. Lana, what keeps you up at night on this one?
Risk number 1 is the Freestyle Libre 3 recall. The FDA linked 860 serious injuries and 7 deaths to faulty glucose readings from certain Libre 3 and Libre 3 Plus sensors as of January 2026. That's a serious quality concern that could dent customer confidence and invite deeper regulatory scrutiny.
Risk 2 is the post-pandemic diagnostics hangover. COVID testing revenue has essentially vanished, and the core diagnostics segment saw a 2% decline in 2025. Abbott needs the Exact Sciences deal to reignite this segment.
Risk 3 is the Exact Sciences integration. $21 billion is a huge check. It increases leverage, adds complexity, and if Cologuard growth slows or competitive screening alternatives emerge, the return on that investment gets challenged.
Risk 4, competition in CGM. Dexcom's G7 is a formidable competitor, and there are new over-the-counter glucose monitoring entrants coming to market. If pricing pressure intensifies, it could dent Libre's growth trajectory.
And Risk 5 is geopolitical. The established pharmaceuticals segment operates heavily in emerging markets: India, China, Latin America. Tariff risks, currency headwinds, and supply chain disruptions in device manufacturing are all live concerns.
Let's do the peer comparison. We're stacking Abbott up against Johnson & Johnson, Medtronic, and Thermo Fisher Scientific.
Starting with J&J, they traded a PE of 21.7 times with 6% revenue growth and a 27.3% operating margin. Lowest PE in the group, but J&J carries the overhang of talc litigation and the Stelara patent cliff.
Abbott trades at a premium to J&J, but Abbott's device-driven growth profile arguably justifies it.
Medtronic is the closest comp in medical devices. They trade at a PE of 27.4 times with 6.9% revenue growth. Very similar valuation to Abbott on a trailing basis. Both companies are benefiting from cardiovascular innovation and diabetes technology.
And Thermo Fisher?
Thermo Fisher trades at 28 times earnings with only 3.9% revenue growth. Different business, life sciences tools, but it shows the market pays a premium for recurring revenue. Abbott's gross margin of 56.4% actually compares favorably to Thermo Fisher's 41%.
So relative to peers, Abbott looks reasonably valued on a trailing basis and arguably cheap on a forward basis, especially given the growth catalysts.
Agreed. The number I'd watch most closely going forward is Freestyle Libre growth. If that franchise maintains double-digit growth through the CMS expansion and the Libre 4 product cycle, Abbott's entire growth narrative holds together. The Exact Sciences revenue accretion is the second most important metric. Investors need to see that $3 billion contribution materialize in 2026.
Bottom line, Abbott Laboratories is a 138-year-old healthcare conglomerate trading near 52-week lows despite guiding for 10% EPS growth. Freestyle Libre is best in class. The Volt PFA system opens a multi-billion-dollar EP opportunity, and Exact Sciences could reignite diagnostics. At a forward PE under 19 times with a Dividend King pedigree and earnings in 3 days, this is a name worth having on your radar.
And we'll leave you with this quote from the Roman poet Marcus Valerius Martial: "Life is not merely to be alive, but to be well." That feels right for a company whose entire mission is helping people live fuller lives through better health.
I love that. A quote from nearly 2,000 years ago for a company that's been around almost a century and a half. That's our deep dive on Abbott Laboratories, ticker ABT.
As always, this is educational content, not investment advice. Do your own research and consult a qualified professional before making any investment decisions.
If you found this episode useful, share it with someone who's researching healthcare stocks. And if you haven't already, subscribe so you never miss an episode. We'll be back soon with another deep dive.
Until then, stay curious and stay informed.
This is Charged Alpha, the S&P 500 stock encyclopedia.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall